Welcome to my YouTube channel. My name is Michael Mansa Liova. My presentation will be looking at working capital management, particularly we'll focus on credit policy evaluation. Before I start looking at credit policy evaluation, I want to explain to you what we mean by working capital management. Working capital management can be seen to be a process or a business process that helps entities make effective use of their capital or their current assets and optimize cash flows. It's actually oriented around ensuring short-term financial obligations and expenses are met while contributing towards longer-term business objectives. Now, when you look at working capital management, there are two bad things that can happen, which can result from how we handle current assets or working capital. These can be taken to be twin evils of working capital management. These can be in the form of one, over-capitalization, which is also taken to be under-trading, or the next one, which is under-capitalization, which is sometimes called over-trading. So let's look at these two one by one. We start by looking at over-capitalization. Over-capitalization happens when capital business working capital becomes excessive. When working capital becomes excessive, that's when we have over-capitalization. It's actually a situation where a company has excessive amount of capital or assets relative to operating needs, leading to inefficient use of these resources. For working capital management purposes, this is typically refers to an excess of current assets. Which current assets are we talking about? Such as cash, inventory, and accounts receivable, in comparison to current liabilities. So now, if these have a bad effect on the business, let's take note of what are some of the symptoms which can help you identify that there is a overcapitalization taking place. Overcapitalization symptoms can include the following. One, you can have high levels of idle cash. When this happens, you are going to see that you lose business opportunity or investment opportunities because your cash is kept idle, let's say, in the bank. Okay, you can also have bloated inventory levels. Now, when you have bloated inventory levels, you actually tying up capital. Instead of using that capital effectively and efficiently elsewhere, capital is held in unmoving inventory. We also have slow accounts receivable turnover. Okay, meaning the debtors are taking longer to pay you, hence creating some liquidity problems for the entity. You can also have low return on assets, okay, and you can also have increased debt costs. Now, what happens in this particular case is that some entities end up contracting more debts despite them having excess capital. Okay, you can also have decline in profit margins. This could result from maybe excess carrying of assets. Okay, for instance, if you are talking about inventory, if you are keeping inventory, you might start having additional costs to be met in terms of handling materials or insurance cover. This will eat up your profits, so you end up having declines in the profit margins. You can also have limited growth and investment opportunities, and of course you can end up having shareholder dissatisfaction. So these are some of the symptoms that can be indicative of an entity having overcapitalization. We move on to look at the other one, which is overtrading. Okay, overtrading, as I've said, is the same as undercapitalization. So, what are some of the symptoms which can be used to identify this situation? You might have one, rapid increase in sales turnover. Rapid increase in sales turnover. So, what will happen is that because you are actually having a business that is trying to do too much too quickly with too little long-term capital, this can result. Okay, so the other one is you can have a rapid increase in volume of current assets and possibly non-current assets. Here you are trying to, as I've said, do more than what you are supposed to be doing. Okay, then you also have only a small increase in proprietors' capital. Okay, and some debt and liquidity ratio might alter drastically. Okay, those are things that we are going to see when you are doing over trading. Then also the ratio of debtors to stock might fall without decrease in bank overdraft. These are some of the symptoms that will be indicative that you are over trading. Okay, so now when you look at this particular situation, okay, we need to look at another component, which is how best can we manage receivables. Of course, when you look at working capital, I've said that this is management of current assets, which include inventory, you can include receivables, you can talk about cash and bank. So I'm going to single out particular management of account receivables. So when you talk about management of accounts receivables, normally you're supposed to be as an entity get guided by policy, okay, of how you are going to manage these particular receivables. So some of the factors that you need to consider in formulating a credit control policy include the following. One, you need to be mindful that there can be administrative costs of debt collection. Okay, when you are looking at the credit policy, control policy, you also need to be mindful of the procedures to control credit to individual customers and debt collection. You also need to think about amount of extra capital to finance an extension of total credit. Okay, and we also need to be aware of the cost of additional finance required to implement this particular credit policy. Furthermore, any savings or additional expenses in operating credit policy needs to be things to be thought about. And also you need to devise ways of credit policy implementation, and also find out what effects can result of easing credit. So this can be in the form of increase in bad debts, there can be increase in sales volume. So that's what you're supposed to consider when you are crafting the credit policy or credit control policy relating to accounts receivables. Now, in looking at credit control policy, I come up with a particular practical example that we can look at, and I'm going to demonstrate to you how we can determine which the best option to assume as a credit policy for an organization. So to do that, I've looked at an example relating to debt collection costs and benefits. Let's say that we have an entity by the name of NIPA Limited, which requires advice on its debt collection policy. Management has approached you for advice. They are wondering whether the current policy should be discarded in favor of option 1 or option 2. We have two options in this particular case. The current sales are taken to be at 4,800,000 kwacha per annum and requires a 15% return on its investment. The table below provides additional information. Okay, so we have a table which shows us additional information. It tells us what the current policy is, and it tells us the two options. It shows us the two options, option 1 and option 2. Under the current policy, expenditure on debt collection procedure per annum is 240,000 kwacha, whereas under option 1 it is 300,000 kwacha. Option 2 is 400,000 kwacha. Then also there's bad debt losses as a percentage of sales, which is taken to be 3% in the current policy, which is billed to be reduced to 2% in option 1, and it should be reduced to 1% under option 2. Then we also have average collection period. For the current policy, the average collection period is given as 2 months, and under option 1, the average collection policy is shown as 1.5 months, which is 1.5 months, and under option 2 is showing that the average collection period is 1 month. So that is the information that is before you, which you need to look at to evaluate the credit debt collection policy of NIPA Limited in this particular case. So how do we proceed in resolving this particular problem? Okay, first of all, I advise those who working on this type of a task in this particular regard to identify what is the average debtors, average amount of debtors. So where do we get that? Okay, we're going to make use of the last line, which is telling you the average months or the average collection period, 2 months, 1.5, and also 1 month. Okay, so how are we going to use it? So you look at this particular situation where we are going to calculate. Okay, so what I'll lead you to is to look at how I'm going to get the average debtors. Okay, the average debtors. So what we have in this particular case is a figure of current sales in the current policy at 4,800,000 kwacha. We are given 4,800,000 kwacha per annum as current sales. So now looking at this additional information, under current policy, we are told that average collection period is 2 months. So this is how we are going to use it. Okay, going to use it. Look at the calculator. Okay, let's use the calculator. What we do is we look at the current sales, which is 4,800,000, or 4,800,000, and then this 4,800,000 kwacha is supposed to be divided by. We're going to divide this by the division that we get from here, which is going to be, in this particular case, we look at in a year we have 12 months. In a year we have 12 months. 12 months. Okay, and then under current policy, the average collection period is 2 months, so divide this one by 2 months. What we are going to get is 6. Okay, what we are going to get is 6. So meaning that the debtors pay 6 times. Okay, in a year. Under current, on average, the debtors pay 6 times. So we come to this particular calculation. If we know that debtors pay 6 times in a year, then we can look at the current sales level of 4,800,000 kwacha and divide by 6. Okay, meaning that on average, the per month, on average per period, we have 800,000 kwacha of debtors. So on average, we have 800,000 kwacha of debtors. So that's how you get to indicate this average of debtors and the current policy of 800,000 kwacha. Okay, we have 800,000 kwacha calculated. So similarly, we look at the option 1. Option 1, in this particular case, option 1, we are told that is 1.5 months, that is 1.5 months. So we look at the calculation here. Okay, look at the calculation. So in this particular regard, for option 1, we are saying the 12 months divided by 1.5 months. Okay, we divide by 1.5 months. What are we going to get? What are we going to get? We are going to get 8. Okay, going to get, let me just confirm, that is 12 divided by 1.5. We get 8. Okay, we get 8, meaning that on average the debtors pay 8 times in a year. 8 times in a year. So we put here, so on average 8 times in a year. So if in a year we are told that the current sales per annum is 4,800,000, we again divide this 4,800,000 by 8. We divide this 4,800,000 by 8. So that's what we are going to do, meaning we have 4,800,000, which is the annual sales, divided by 8. Divided by 8. So we get 600. So that gives us our average debtors under option 1 as 600,000 kwacha. Average debtors under option 1 as 600,000 kwacha. Okay, we move on to look at the next option. The next option, we are told that on average it is average collection period is 1 month, meaning that in a year you are going to collect 12 times. Okay, in a year you are going to collect 12 times. If the annual sales is 4,800, you divide this 4,800 by 12. Okay, you divide this 4,800 by 12. 4,800,000. 800,000 divided by 12. You are going to get 400,000. Hence this 400,000 which is given here. 400,000 which is given here. So that's how we generate these particular values. That's how we generate these particular values. Okay. So now not the 400,000, I mean this one here. Okay, that's how we generate these particular values. So once that is done, then we move on to see what has option 1 got as an effect. Option 1 with average debtors standing at 600,000 is showing that there is a reduction in working capital by 200 from 800,000 to 600,000 kwacha. That is showing that there is a reduction. There is a reduction. So that's what we are seeing in this particular case. For option 2, since the average data is now 400,000, it simply means that it has reduced from 800,000 to 400,000. So there's a reduction of 400,000. See, these are the reduction which are showing by option 1 and option 2. These are reduction. Okay, so now what are the interest savings? Okay, so what are the interest savings? We calculate 15% on the reduction. So 15% of 200,000 will get 30,000. Also 15% of 400,000 will get 60,000. Okay, so 60,000. So that's what we are likely to see. Okay, then we have bad debt losses. Bad debt losses, we look at this particular situation. We take bad debt losses is 3% of sales. 3% of sales under current policy, and 2% on sales under option 1, 1% of sales under option 2. So that's what we have. Reading from that, it simply means that when you look at bad debts, 3% of the current policy, the sales are 4,800. So we come to sales 4,800, 4,800,000. So multiply by 3%, which is multiply by 3%, which is the same as 0.03. Okay, you get 144,000. You get 144,000. You get 144,000. So that's the 144,000 you are seeing here. Okay. So what of the option 1? Option 1, the sales as the working capital is reduced by 200. So let's see what happens in this particular case. Okay, so the sales are reduced by 200 rather. So you have 4,600, 4,600,000 kwacha, and then multiply by 2%. So rather the average sale, that's 800, multiplied by 2%. That is 4,800,000 multiplied by 2%. That 0.02 is going to get what is wrong figure. Get 4,800,000. Okay, multiplied by 0.02. What do you get? You get 96. That's a value you get there. You get this 96. That's a value you get there. Okay. Then under option 2, the bad debt losses we are told is 1%. So 1% of 4,800,000, like before. 4,800,000, 1%, you are going to get 1% of 4,800,000 is 48,000. The calculation is similar to what we have done to calculate 144,000 and 96,000. Maybe I repeat this one. You get to the 4,800,000. 4,800,000 multiplied by 1% is the same as 0.01. That will give you 48,000. Is the 48,000 you are seeing here. Okay. So now with this type of effect, as that of option 1 and option 2, what do we see as a reduction in losses and sales value? So from 144,000 dropping from the current policy of 144,000 bad debt loss, we have option 1, which shows that drop is that we drop it to 96,000. There's a drop of a total of 48,000. What of from the current policy compared to option 2? There's a drop by 96,000. That's why we have 48,000. There's a drop by 96,000. So that's the effect these two options have on the bad debt losses. Okay. So now, what is the total benefits of this option? We look at the summation of effect under A and under B. Okay, so in this case, we look at 30,000 under option 1 plus 48,000, which gives us a total benefit of 78,000. Okay, And also we look at this option 2. In this case, we are looking at 60,000 added to it, 96,000 to get 196,000. That is the total benefits under the 2 options. Now, what happens in this particular case? Okay, what happens in this particular case? We look at what we are told here. Okay, there is the increase, okay, in expenditure on debt collection per annum. So current policy we have 240,000. Option 1, it rises by 60,000 to 300,000. If we had to follow option 2, it will rise by 160,000 to 400,000. So we have to factor that inside these calculations. So we can see extra cost of debt collection under option 1, there is an increase of 60,000. Under option 2, extra cost of debt collection, there is an increase of 160,000. So now we have taken care of all the issues that need to look at under option 1 and option 2. What is the net effect? What is the net benefit or net loss? So we look at this in this particular case. So we have a total gain of, I can say, 78,000. Okay, under option 1. And we have again at the same time incurred extra cost of 60,000, meaning that the net gain is 18,000. Net benefit under option 1 is 18,000. What of under option 2? We have a net benefit which has increased to 156,000, but at the same time that will entail that we suffer extra cost of debt collection of 160,000. So this will show us there's a net loss of 4,000. Net loss of 4,000. So given these 2 scenarios, okay, option 1 and option 2, then you can advise management that you better go for the credit policy under option 1. Why? Because it guarantees that we're going to benefit by an increase in benefits of 18,000. Option 2, as you can see, does actually worse off than the current policy. So the best option is option 1. So that's how we come up with the evaluation of credit policy for companies. That's how we come up with the evaluation of credit policy for companies. So that's what I wanted to show you on this particular presentation. So thank you for listening. If you have any questions, you can actually contact me or drop me a line so that I work on what you are not sure of. So please don't forget to subscribe to my channel and like my presentation or like my videos. Thank you for listening.